Humanity's pursuit of wealth is somewhat timeless and universal. And for some people, nations, cultures, they've tried to achieve this through power, conquest, and empire. For others, they've chosen to pursue wealth through innovation, competition, and cooperation. But modern financial markets have allowed for the creation of a new way to profit. And this is something that is becoming increasingly controversial these days. And that method is short selling. Short selling is essentially the ability to profit off of somebody else's losses. Now, on the surface, obviously, making money from somebody else losing money sounds dirty, maybe unethical, and potentially even dangerous. This is leading people like Dimon to say regulators should ban short selling of banks, sparking a debate about whether short selling is net beneficial or damaging to markets. Now, it's true this debate has been going on for a long time, especially in times of market turmoil. But if we're going to explore whether short selling is actually something that is damaging to markets or is net beneficial, then first we have to look at what short selling really is.
First, I'd like to tell you about today's sponsor, I Trust Capital. Today, people are concerned about the purchasing power of their dollars being eroded due to inflation. They're concerned about the returns they're getting on their traditional portfolios, things like stocks and bonds. Many people want to be able to purchase investments that will preserve their purchasing power, things like gold, silver, Bitcoin, ways to store the value of your money without being exposed to the dollar. What's the problem with this? The problem is that most people have most of their wealth in their 401ks, their employer's retirement accounts. And these accounts do not allow people to buy gold, silver, or Bitcoin. Some of them allow access to ETFs that have exposure to these prices. But number one, you're introducing many layers of counterparty risk. And number two, you don't actually own the asset itself. That's where I Trust Capital comes in. I Trust Capital allows you to open up actual retirement accounts, IRAs, traditional and Roth. You can even roll over funds from a previous employer's retirement account to fund this. You can buy gold, you can buy silver, you can buy Bitcoin and even other cryptocurrencies with I Trust Capital. And if you sign up with my link in the description below, you'll get $100 worth of Bitcoin as a sign-up bonus for opening the account.
So what is shorting? Very simply, when you short sell something, it requires two steps. Number one, you borrow something. And number two, you exchange it for something else. That's it. There's nothing fancy going on here. There's no derivatives. This isn't gambling. There's no bets being placed. A short sale is simply selling something you don't own yet. And in order to do that, you have to borrow it in order to sell it. Let's look at an example of an iPhone. You have a friend that has an old iPhone that is sitting on their shelf in their closet that they don't use. They're just keeping it there just in case their current phone breaks. Now, let's say you have some information, some scoop that you think Apple is potentially going to come out with a new iPhone in the next 6 months. So you go to your friend and you say, hey, can I please borrow your iPhone 10 from you? He's not using it, and so he says, sure, if I ever need it back, just give it back to me. And you say, great. So you take his iPhone 10 and you list it on eBay and you sell it for $500. Turns out you were right. Apple releases a new iPhone in just a couple of months. Those iPhone 10s now that you sold for $500, you can now go online and buy them for $400. So you go online, you buy another iPhone 10 for $400, and you go back to your friend and deliver the phone back that you borrowed. Same phone, same condition. He is happy because he never needed the phone and he gets his same exact phone back and you profit the $100. So shorting is very simply borrowing something and exchanging it for something else. And this makes sense when you're exchanging it for dollars, but most people aren't aware of a second example of shorting, which is mortgages. Think through the process of what happens when you buy a home with a mortgage. You first borrow something, that is US dollars, and then you exchange them for something else, that is a house. You owe back dollars. In the iPhone example, you owed back an iPhone. You didn't owe back a specific number of dollars. You owed what you borrowed. In a mortgage example, you owe back dollars. And so theoretically, if the dollar goes down compared to the house, another way of saying that would be the house goes up compared to the dollars, then at some point you unwind the trade, you sell the house and exchange it for dollars and give those dollars back to the bank, and hopefully as a result you have more left over. So both buying a home with a mortgage and the example I gave with the iPhone are examples of short selling. It is simply selling something that you don't own by borrowing it first, and then later to close out the trade, you're going to have to buy that thing back. So how does this work with stocks? Because you can't just call up your Aunt Sally and say, hey, can I have some of your GE stock because I'd like to short sell it? Can I borrow it from you? That's not the way it works. And it's a good thing because it's a lot easier than that. All you have to do is go to your broker, you go online, place a trade, and instead of clicking buy, you click short sell. Now you will have to have a margin account for this because you're borrowing, and a margin approved account is one that allows you to borrow. Normally people think of this as borrowing dollars in order to buy extra stock, but you also need a margin account to borrow shares in order to sell those shares because you don't owe them, so you got to borrow them. Now this borrowing of those shares is all done automatically. When you short the shares, your broker will go locate those shares for you and let you borrow them from them, and it's all done streamlined, easy, simple. But there are certain circumstances where those shares are not easy to borrow. Everybody remembers in 2021 the short squeeze that happened with AMC, and especially the short squeeze that happened with GameStop. In situations like this, when there is high demand for shorting shares, everybody wants to borrow them. And what happens to something if there's high demand for borrowing it? Well, suddenly it has an interest rate associated with it. You have to pay to borrow. And that's exactly what happens with stocks. If there's a high demand to borrow them and you want to short them, you may have to pay an interest rate in order to borrow them. This is one of the incentives given to the people who own the shares so that they will allow other people to borrow them and short them. This is called a fully paid securities lending program. Essentially, if you have a couple hundred shares of Apple and you're not going to sell them, you can sign up for these programs at your broker and you can say, hey, let people borrow these shares. And if they're in high demand, then I get to get paid an interest rate on them. And you still own the shares. So if something happens and the stock moves wildly and you need to sell them, you can sell them at any point you want. And the broker will just go to the other side of the trade, whoever borrowed them, and force them to close. They'll get those shares back for you. Okay, so now we understand the mechanics of what's actually happening when somebody short sells and how those shares are located to begin with. But what are the ramifications of this, and how much damage does this really cause to markets and to companies? Well, obviously there's a built-in profit motive here to see a stock fall, because if I borrow stock and I sell it, then the only way I make money is that I can buy it back at a lower price. And so when I'm short selling a stock, I need that stock price to drop so that I can profit. This means that there's an opportunity for speculative attacks and people to spread false information, jump on a bandwagon to try and crush a company just to profit off of it. This is what many people were saying was happening to GameStop and AMC before the short squeeze commenced. There is a very famous short seller out there, Hindenburg, who released a short report on Adani Enterprises, and Adani said the exact same thing, that Hindenburg was spreading false information just to profit off of a collapse in their share price. Now, it's absolutely true that this can damage the reputation of companies, even for a long period of time, as they have to battle it out now and fight and constantly be talking to the press and releasing reports trying to contradict what the short sellers are saying. During the years of 2014 through 2019, Elon Musk was doing this quite a bit with short sellers, as Tesla was one of the highest shorted stocks up until about 2020. But beyond short-term and potentially long-term damage to companies and their reputations, the issue today is that it may have the ability to even spark bank runs. This is why Jamie Dimon is saying that regulators should actually ban the ability to short sell bank stocks. Because with a bank, especially in today's day and age, they have all their assets invested in things like US Treasuries. That means that in all likelihood, as long as they allow those assets, bonds, to mature, they'll get all the money back. They've loaned that money out and they're more than likely going to get it back in order to meet deposit requests. But That also means that if everybody requests to get their money out right now, then the bank will go under, because if a bank run starts, those assets are currently at a loss and they don't have enough time to wait until that debt gets repaid. And so if a bank run starts, it's likely the bank goes under. And when the shares of regional banks like PacWest, and as the shares of regional banks have taken a major dive over the last couple of months, this is sparking major concern with depositors at some of these banks. They may just be looking at the stock price and thinking, my bank's in trouble, I better go get my dollars out. And then if everybody goes and gets their dollars out, well, then the bank actually does collapse because they have to realize all those unrealized losses. And if they collapse, that stock price goes to zero. So you can imagine a very real scenario here where a bunch of people can load up on shorting these bank shares and watching the price fall, spreading rumors about insolvency, and then everybody goes and does a bank run, gets their money out, and then causes the bank to collapse, and the short sellers win, even though that bank may have never collapsed in the first place, as long as they were able to hold those bonds until maturity. So with all the damage and danger to markets and the functioning of markets and the health of companies to be able to perform long term, are there any reasons to keep on allowing this practice to happen? Well, yes, I'm glad you asked, because there are quite a few reasons why we should allow this to keep on happening, and I'm afraid they far outweigh the reasons to ban it. First of all, I would like to point out that nobody ever talks about the damage to markets that happens from the opposite of short selling, speculative buying. Bubbles are far more damaging and destructive to wealth when everybody rushes in and buys something and pushes the price up, and then the market realizes it is overvalued, and then that wealth is destroyed. But nobody's talking about preventing bubbles and preventing people from buying stocks when it looks like there's a bubble, and that's because all the major players here that have the sway, the political sway to try and push laws, they own these assets. So if they're gonna ban something, or if they're gonna push to get something banned, they're gonna try and ban the thing that could make the stock go down, not the thing that could make the stock go up, even though it could be even more damaging to allow these bubbles to occur. Second of all, when you do see bubbles occur, the people who are going to stop that from happening are the sellers. And if you only allow somebody to sell if they've already bought, then you have no equal and opposite market force to counteract the buying that causes the bubble in the first place. A short seller could very easily just look at a stock and say, this looks overvalued to me. I'm going to short it here because I think it'll go down. And if enough sellers, whether they're long and then selling and closing out their long, or whether they're entering into a sale through a short, either way, that's selling pressure that can tamp down the fire of a bubble. Number two, short sellers are the only people out there who are actually halfway decent at sniffing out fraud. Do you guys remember that guy who created a little Ponzi scheme? His name was Bernie Madoff. Yeah, that little old Ponzi scheme. This fraud went undetected for decades despite numerous warnings, red flags, and a general sense on Wall Street that something wasn't right. People literally wrote in to the SEC saying something's wrong here, you need to investigate. And they did nothing. It's almost like incentives work here. If you have an incentive to find fraud or an incentive to find something that is overvalued, like a profit motive, then you'll be the one to go out and try to do it. And a regulator who has no incentive whatsoever to find that fraud, they'll probably not be as good. Another case in point about this is Carl Icahn's company, Icahn Enterprises. This is another target of the short selling group Hindenburg Research. This company, Icahn Enterprises, had not a care in the world. There was not a single regulatory agency doing anything. Suddenly, somebody comes out with a giant short sell report on the company. Subsequently, the stock price drops off a cliff. And shocker, suddenly regulators are now interested in the company, as the US Attorney's Office has now filed a request for information. Now, this Hindenburg Research Group, they are quite a famous short seller. They're pretty good at it. And they were one of the ones that found out about the fraud taking place at Nikola, among many other companies. Nikola was a company that that fed off of the easy money regime in 2020. A huge bubble formed, and then when the short sell reports came out, and then they admitted that their prototype semi-truck was actually just rolling down a hill in a promotional video, well, their stock price obviously collapsed from there, from a high of about $93 per share to a current price at about 83 cents per share. Essentially, short sellers have skin in the game. If they are right, then they will profit handsomely. So they have an incentive to find the companies that are overvalued, sell them, find the companies with fraud, sell them, and tell as many people about it as possible. This is a service to the markets. If you're somebody caught owning these shares, it is a good thing to find out about this so that you can sell them and stop the damage now instead of losing more money and investing more money in these companies long term. And I'm not speaking as a bystander here. I own companies or have owned companies specifically that Hindenburg has recently attacked. And guess what I did? I was thankful and I either paired or got rid of my positions. Other companies, I took a look at the report and thought, you know what? No, I don't think that's accurate, and waited for the company to respond and have still held my shares, and the companies have performed well since then. And this points out the other side of this, that short sellers have skin in the game on the loss side too, because if they're wrong, what do the share prices do? They go up. And so there are not nearly as many speculative and fraudulent attacks by short sellers as the media likes to portray, because if short sellers try and do that and they're wrong, the stock price goes up as a result and they lose. Instead of profits, they have losses. And so they've got real skin in the game here to make sure they're actually finding things that are overvalued, actually finding things with fraud, and they're good at it. This is again not true of regulators. If you do not have short sellers, then companies don't have skin in the game to make sure they're not artificially inflating their stock price. They won't be worried about anybody being able to come in and force the price of their stock down. The only people who can sell are people who have already bought, meaning those trades cancel each other out. Regulators simply do not have the profit motive or the loss motive to find fraud and make sure they're right about it. Tesla is a perfect example of a company where short sellers were wrong. For all of 2017, 2018, and 2019, Tesla was one of the most heavily shorted stocks in the United States. As the short sellers were proved wrong, they had to close out their shorts and the stock price rocketed up to unbelievable heights, which just means that when a short seller or a big short seller group comes out and releases a report and a stock price drops as a result of a bunch of people shorting, if they're wrong, it gives anybody else the opportunity to buy the stock at a discount, because the share prices are now by nature, by definition, artificially lower than they would be without that short selling there. Therefore, if they're wrong about it and then those short sellers have to close out their trades, the stock must go higher than it was before, all else being equal. So short sellers being wrong actually create an opportunity for the long investors to make an even larger profit. And finally, short sellers also provide the very small benefit of providing liquidity to a market. If everybody's trying to buy something and nobody is selling it, then you could have a stock pop up extremely quickly to unbelievable highs. That is not healthy for any market. Short sellers are the ones who come in and say, even temporarily, I think this stock is overvalued, and I think it's going to come down even a little bit, and they are there to provide these shares, to be the ones to provide that liquidity so that somebody can buy at the current price instead of just driving that price up through the stratosphere. Even being a liquidity provider is a major benefit and vital function to the market. This is not something that you just want to ban willy-nilly. Short sellers are vital for the healthy functioning of markets. And you can bet your bottom dollar that if somehow somebody is able to get pushed through the ability to ban certain types of stocks being short sold, then the next thing that will happen is all stocks will be banned from short selling. And when the resulting bubbles happen from that and overvaluations go through the sky and stocks go up and can't do anything else, you know what they'll do next? They'll ban bubbles, and markets will become a fully regulated, they won't be markets anymore. Markets imply some sort of freedom. There will be none of that. There will be forced ownership or forced non-ownership. It will cease to be a market. So while While it may not be fun to be the one in the middle of a short seller attack, just understand that if you're right and they're wrong, you'll make money in the long term. And if they're right, you want to know about it and you want to see those reports so you can get out and save your money. If you're the type of person that wants a little bit more agility with the markets and want to be able to do maybe some short-term trading or some long-term trading and follow along with being able to profit off of bubbles and watching these overvalued companies come down, that is available to you too. You can open up a margin account and engage in short selling at any major brokerage firm in the United States. As always, really appreciate you guys. Thank you so much for watching. Have a great day.